Thank you. Good morning, students. I'm sure in many places it is a chilly morning. In some places it may be a cozy warming, but with me together we'll be having a PGBP morning, right? A morning where we are going to delve deep into the PGBP provisions, PGBP concepts, income tax related different pointers, wherever required, some practical issues, right? And we are going to have a great rocking start for this day and also the act. So I'm sure you all are ready for this. I'm sure in the previous class, whatever we discussed, studied, that would have given you all a good walkthrough into the subject and also a proper approach how to deal with PGBP, right? So yes, very good morning to you all, Navni, Linga R, Pooja, Kamli, everyone. Very, very, very good morning. So let me just summarize before I proceed. So we are discussing the topic of PGBP head, business head. I'm sure why you all know why it is called as PGBP, because the name given in the law is profits and gains from business and profession, PGBP. Now we have been since childhood taught to look at books of accounts in a T format. So I've drawn a T format of your profit and loss account. And in this format, we have been preparing, though now it has changed to vertical. Now the point is that when you are given a trading P&L account in your exam sum, along with additional information, you will be called upon to compute generally the total income, because this always is a part of comprehensive sum. Plus also you may be called upon only to compute PGBP income. Plus this may also be the question related to your MCQ type or case scenario type. So there are various methods through which you may be getting exactly this type of question, where trading P&L information is given, some expenses, incomes, and additional data is given. Now, if comprehensive sum is required, so from that, you'll be preparing your computation of income with 5 8s, GTI, then deductions under chapter 6A as applicable, depending upon your method of new scheme, old scheme, taxation method you have adopted, TI, tax rate, again, depending upon the regime you are opting for. And from this, after deducting TDS, TCS, advance tax, if any, you get your final tax payable or refundable. Correct, students? Now, for the purpose of computing income, especially from a trading P&L format or trading P&L question, you are supposed to keep the first most important thing or step in mind, which I call as segregation. So first thing that you should be able to do is, from the data given in profit and loss, you should be able to identify, okay, the question deals with, let us say, these 4 heads details. And these incomes, these expenses belong to these heads. So example, let us say rent received, depreciation of house property, municipal tax paid on house property. These are all belonging to house property head. What it will be done over there, whether allowed, not allowed, fully allowed, partly allowed, that is a different thing. But first, since all these belong to the same source, and the source is business head, house property head. So the first thing that you should understand is mentally this picture should be in front of your eyes. But okay, all this data will be part of this working. Now, why to identify it this way? So that we understand that in PGBP, what adjustments we are supposed to do. So you identify what workings or what information in the sum pertains to HP, what pertains to CG, what pertains to OS, so that we know in our PGBP computation that what has to be nullified, the effect of what has to be nullified. Now, when you have to do this PGBP working, for PGBP, you can adopt one of the approaches. Format one is the PGBP P&L. So you can redraft the P&L only considering the business head items. Format two, which is the format we are going to adopt and which is always adopted, is the reconciliation format. Now, just for again visualization and understanding the concept purpose, what is the P&L format or what you would be doing in the P&L format? If you adopt this format, you would consider only that revenue which pertains to business head, and you will consider only those expenses which pertains to business head. So this is the first step, which is segregation. So you have segregated and you have collated the data here only belonging to business head. But that is not sufficient. After doing segregation, the second step is applying the business head provisions. Now, when I say applying the business head provisions, it means two things. One, whatever items are already there, what is brought under this format after segregation, whether the values are going to remain same or as per the PGB provisions, the value has to be taken a different amount. Second thing that you'll understand while applying PGP provisions is whether the items which are already there, items of expenses, items of income, whether any new item has to be added in that or whether any present item has to be removed. Why? Because the PGP provisions so require. So these two things is what I consider in part 2, that is applying PGP provisions, and that you will come to know after studying the PGP provisions, which we started in the previous class, and today we'll reach a major part of it. Now coming to the main format that will be adopted. The format that will be adopted is the reconciliation format. Now, what is the ideology of the reconciliation format? This point is very important. And if you understand this, understanding the format, understanding ADLESS is then very simple. So the ideology is you have to always remember that we are starting in that format from this figure, which has come considering all these expenses and incomes. So we start with the net profit as per accounting P&L in the reconciliation. So when you take this figure here, and this figure is then considered as your starting point in the reconciliation, you have to keep in your mind that this figure has come after adding all the items on the income side of accounting P&L and after subtracting all the items on the debit side of the accounting P&L. So whatever accounting P&L is drawn, in that items on the credit side are added in this figure. Items on the debit side are subtracted from this figure, and that is how this figure stands in front of you, which is a net of this two. So the point is that once you understand this, that this figure is made up of credits which have been added and debits which have been subtracted, then you'll understand that when we are doing our reconciliation to reach the final PGBP head income, what has to be adjusted. So adjustment is either by subtracting, either by adding to this figure. This is important. Please understand this simple maths. If you have understood this, you will find the PGBP computations much easier, much manageable. Now, those items which are on the P&L credit side, they have been added in the net profit. Now, applying the PGBP provisions or applying the segregation, if you identify that some of these incomes which are already credited in P&L, but they are not taxable under the PGBP head. Why? Because of step 1 or step 2. Segregation, that is because they belong to other heads. 2, because after applying PGP provision, you find that there is some difference either in the values that has been considered or either that item has to be not considered in PGBP. Now, if that is the case, those items, whatever they are, you will make a list and you will subtract them. Corollary on the similar lines, those items of expenses which are debited in your profit and loss, it means they have been subtracted from this figure. Those items, if they are not allowed as deduction, means PGBP does not consider it as an expense. And if it does not consider it as an expense, it means it will not allow you to deduct that. So PGBP is not allowing you to deduct that expense. Hence, you will add those items. So you make a list of all those items on the debit side of P&L, which either because they belong to other heads or either because of the PGP provisions, they cannot be deducted. So they will be considered here and you'll add all of them. Why? Because in this net profit, while computing this net profit figure, they have been subtracted. So you are simply nullifying the effects. Then comes the second type of adjustments, that is those incomes which are part of PGBP, but for some reason they have not been taken in the credit side of P&L. Now, if it is not taken in the credit side of P&L, it means it has no effect on this. See, whatever is not debited and credited to account in P&L has no effect on this. Now, I want to give effect of this. What effect I want to give? I want to make these incomes taxable under PGP. So for taxing it under PGBP, I will have to add it because it is income. And on similar lines, expenses which are allowed as deduction under PGBP, those expenses which are allowed as deduction in PGBP, but for some reason not debited in your accounting P&L. So it means no effect of that has been given. Then now you will be giving effect to them. How you will be giving effect to them? By subtracting them so that the correct effect of expense, that is subtraction from profit, is given. And then comes further those items where because of PGP provisions, you have to take some different value than what is given in P&L. For them, You will be taking the difference and you will be making the effect of add less, whatever it is. Second. So this is how the format of PGBP is derived. Now for solving the questions of this format, the first thing that we need to know is what items are not part of PGP, that is step one. This is easy that you can do even today because that only requires a basic understanding of what belongs to other heads. But for the second part, that is applying PGP provisions, what you need to do is you need to actually understand the PGP provisions, understand the effect of them. What effect you have to understand? Simply whether if it is an income, is it taxable under PGP? And if it is an expense, whether it is allowed as deduction and at what values. That's it. Once you understand this, whether a particular income is taxable and at what value, whether a particular expense is deductible and at what value, then after you understand this, then doing addless over here will depend upon your understanding of the format. Correct? Now I have given these notes. I'm sure they will be uploaded, if not by now. And I've also shared or made a practice sum for your practice, though these are not the exam level sums, but just as starters to understand this format, what we are solving. I've just crafted two sums. Now, question number one, I want y'all to apply whatever I have just explained, which we did in the previous class. I've just revised. Now for this is the P&L and these are the adjustments. So there are two questions given parallelly. You will only focus on question one given on the left-hand side. How you will proceed? First, in the question itself, mark those items which are not part of PGBP so that you know that these items have to be anyways adjusted. What add less that you will decide or you can mark here itself. Like normally what I do is when I'm reading the question and if I feel this item, let us say dividends, is not part of PGBP. So I know adjustment has to be done. What adjustment has to be done? I will mark here less. Something like this. Correct? I'll do one thing. I'll first show you one part, the main P&L and the adjustment so that you all can take a screenshot in case it is not there. 1 second, Nagaraj. I'll zoom in. I'm just zooming in. So first, I'm taking the P&L part. You can take a screenshot of this. Take a screenshot of the students. Done. Now the adjustments part. Take a screenshot of this. Perfect. Now I give you 5 minutes. Question one. Just do markings here against each item here. If you feel any of these items are to be adjusted in the reconciliation, which is our format, just put the sign add less, whatever you feel. Also read the adjustments because for some adjustments you require, or for some markings you require adjustments to be done. But maybe you can first start with P&L, do the markings in the P&L on the basis of the names, and then also read the adjustments and do the markings. Chalo, 5 minutes. Okay, let us discuss. So I start from the income side. They have given GP. This is part of PGBP. PGP means that there is no exclusion for this. We will leave it as it is. Then comes interest on FD. We know it is part of other sources. So in the reconciliation, you'll have to subtract it. Dividends, other sources, subtract it. Profit on sale of shares, CG, subtract it. Salary, subtract it. Sundry receipts. This, if you remember my last explanation, we have three sections for determining PGBP incomes. This is part of section 28, which covers two things, direct, indirect. So this is the direct revenue arising from your trading activity, and this is the indirect revenue. Sundry, yes. If there is something even in the adjustments, after considering that, I'll take a final call. But for the time being, I'm keeping it simple. So I've excluded it. Somebody's saying gift minus. Okay, yes, I'm coming there. Yes, you're right. So sundry, for the time being, I'm not doing anything until unless if there is any adjustment. But plainly by reading the name or terminology given, it can be part of section 28 as an indirect revenue. Again, gift from close friend, it is also not part of business head, subtract. Correct? Okay. I'll just scroll through the adjustment. It is dealing with salary, repairs, depreciation, administrative, and sundry receipts. Now, this will help me finalize whether I need to do anything for sundry receipts. So what it says, it relates to sale of scrap. And it is part of, like if you remember in my previous class, when I was explaining you section 28. So what did I explain? That 28 covers direct and indirect revenues both. And in indirect, I gave you example of this only, that as a CA office, we generate lot of unnecessary papers. There are some obsolete documents, files, which periodically we sell as scrap, plus all the small and big items which are used in the stationery, etc. So whenever they are of no use, they become obsolete, we sell them as scrap. Selling scrap is not my business. So it is not a direct revenue, but it is arising from some business activity. Hence, it is indirect revenue. It is part of business head. So for this, no, Navneet, you are saying add back. I will not do anything of this scrap. So in this list, these two items, I am not doing anything. No add, no less. And for these items, I will subtract in my reconciliation format. And rather the last one also, that is gift. This I will subtract, but I'll do nothing for 1 and 2. Navneet, is this clear to you? I will not add back. So don't say Anil, ignore. Simply say that we'll do nothing. Why? Again, remember my logic of reconciliation. The net profit figure is our starting point. Net profit is already included in this. So these all items which are on the credit side of your P&L is already included in the net profit. On the credit side item, it is already added. And if I want to take that in PGBP also, I need not again add it because it is already added. Correct? So this logic is important. Once you all understand this logic, it will be clear. Fine. Okay, great. Perfect. Now I come on the debit side. Now debit side are those expenses which are already subtracted while finding the net profit. It means the effect of all these items is already minus. Now, if PGBP also allows them as an expense, means PGBP also says that yes, we are also going to minus, I will do nothing because it is already minus. It is already deducted. But if PGBP says no, no, this expense I don't allow. One, because it pertains to other heads. Two, because of the PGB provisions that we are going to study, then what you have to do, you have to make an adjustment. So first, by the name, salary, advertisement, repairs, depreciation, rent rates, all these do not appear to have any problem because these are all business related. Yes, personal tax by the name itself understand that it is not part of BGBP. Why? Because it is personal. Again, GST, legal charges, audit fees, customs duty, all this is related to business. So by name, they do not appear to have a problem. Loss on sale of machinery is again pertaining to other head. Interest on capital. Now, this is important. This is simple accounting logic as well, that you cannot pay interest to yourself because you and the business, if the entity is same, there will be no expense in the eyes of law. Yes, if you, that is individual, and business, that is a company, that is a partnership firm, then we can consider this interest because then there are two separate entities in the eyes of taxation law. But if it is proprietorship, then you and the proprietorship both are one and the same. So this is also not eligible. So we, by the name, have identified few expenses, which by the name itself we understand will not be allowed as deduction under PGBP. But since there are a lot of adjustments, we will read these expenses in the light of adjustments so that in the first point itself, first go itself, we land to the answer. Yes, Navneet, you're right. Very good. Yes, Mustafa, correct. So now my first adjustment is saying salary includes 3,000, which is paid to a domestic servant. So out of the total salary debited here, so prima facie salary has no issue because it is a business expense by the name. But out of this 3,000 is personal. So 40 overall is not a problem. Within 40, 3,000 is a problem. And 3,000 is not a business expense. Now, please understand again, in reconciliation, this entire 40,000 is already subtracted from the net profit, which we are taking as our starting point. Out of that 40,000, 3,000 cannot be subtracted. So in my reconciliation, my adjustment will be only of 3,000. What adjustment I will have to add? So in the reconciliation, I will add 3,000 towards personal expense of salary. Perfect. Very good, everyone. So keep responding, replying. It will keep me also very much on my toes. Now, for advertisement, there is no adjustment. So no problem. Business expense allowed in full. Repairs and insurance, there is an adjustment which says repair again includes 3,500. Repairing to your house. Again, repair to house is not part of PGPP. Maybe it may have been considered in HP, but at least in PGPP, it is not a part of business expense. It is related to house property, that also residential. So anyway, is not part of PGP. So what I will do is, out of repairs, 3.5 is not eligible as a business expense. So add. Correct, everyone? After so many messages. Very good, students. I'm happy that parallel to me, you all are also putting your answers. So I like this approach. Who is following this? Yes, Navneet is doing good. He's writing the adjustment number like 1, 2, 3, and he's simply writing add less, whatever he feels. So that he's giving me the answers. So you can also post your answers accordingly, or you can put the name and amount, whatever is comfortable to you. Okay, super. Okay, fine. Very good, everyone. Perfect. What happened? Okay. Now proceeding further, depreciation. Now in depreciation, what is the adjustment? As per income tax, this I explained last time also when I was explaining about the value difference, that many times The income tax provision has its own calculation because of which the amount that you may get under income tax is different. So the item is same, the expense or the income is same, allowed under both accounts and income tax both, but with different values. So as per your income tax workings, which are given in income tax rules, 40,000 is eligible as depreciation expense. Now, since depreciation expense of 40,000 is eligible as per income tax, in accounts we have considered 36. Now, see here, there are two approaches. What are they? So let us say I am solving this sum. So it is computation of PGBP income, net profit as per accounting profit and loss account. How much is that? It is 213. So 213. And in that add and less, right? Now in add, let us say I have written add for these two items. So salary to domestic servant in bracket personal expense 3,000, repairs to residential house again personal expense 3,500. In less I have written names of all those expenses which are part of other heads like dividends, interest, and so on. Now, what I was trying to explain you is now for depreciation. If you remember, when we were discussing the format, I had explained you like this. So you'll take the difference, whatever it is, and then logically you will decide whether this difference has to be subtracted or added. And let me tell you, whenever there is value difference, it can be anyways. It can be added also, subtracted also, depending upon what is the effect in net profit and what is the effect to be given in PGBP. Now, many times, other adjustments, students don't get confused about add or less. But whenever there is a difference, like here again in this sum, depreciation of accounts is there, depreciation of income tax is there. Many times students may get confused that difference has to be added or subtracted. So one way is you give effect to the difference. But if you are getting confused with that, I'll give you another shortcut trick. Now this trick is for all those items which are going to be considered in business head, that is PGBP, and they are also considered in accounts. It means it is appearing in both set of treatment, but with different values. For such items, instead of taking difference, if that is confusing to you, simple trick is add the whole amount, subtract the whole amount. I repeat, add the whole amount, subtract the whole amount, don't take difference. Now, what do you mean by this? Now, whatever depreciation given in accounts, it is as per accounts. It is already subtracted in this figure. I don't want to take that figure. Let us say. So what I will do, I will add that figure, depreciation as per accounts. So since it is already subtracted in this, and I don't want that figure, so I will add the whole figure, right? So how much is that figure? In accounts, the depreciation is 36,000. So what I will do is I will add this 36,000 fully as if I don't allow that entire expense. And the same thing I will do here. Now, logic is what? There is a depreciation expense as per income tax, which income tax allows. And if it is an expense which is allowed by income tax, what you have to do? You have to subtract it so that since it is an expense allowed by income tax PGBP head, PGBP income should be subtracted. So simply what I will do, depreciation as per income tax provisions. How much was it? It was some 42. Yes, it is 42. So I have added the whole expense which is given in accounts I have subtracted the whole expense, which I get as per PGBP. So this approach is the second approach wherever you have to give the value difference adjustment. So this makes life easier for students. Ki I don't have to do the janjat of deciding or thinking during exams, because many times during exam pressure, it may be stressful, and you may make some calculation or clerical mistake, either in taking the difference or either in deciding addless. So this is simple, correct? Yes, yes, exactly, Anil. So I mean to say, nullify the earlier figure, which is in accounts. How nullify? Since it is expense in accounts, I'll fully add it so that it is nullified from net profit. And then again giving the effect fully of the new figure, which is as per income tax, which is an expense, so I subtract it. Correct, Anil? So you can say so. Or as rightly pointed out by many, I can directly deal with the difference of 6,000, which in this case will be subtracted. So if anybody wants to deal with the difference, it will come in the less. But again, don't learn any such thing that depreciation difference will always be less. If the figures would have been vice versa, the difference would have come in the add part. I'm sure you all understand this mathematical difference. Super. Good. Let us proceed. So we have done for depreciation. Now my other adjustments are administrative, sundry, 6,000 not eligible, 135 not recorded. Okay. Rent rates, no adjustment, and it is related to business. So we'll keep it as it is. Personal tax, by the name itself, we understand that it is not related to business. So I have to remove the effect of this. How I will remove? Since it is an expense, it is already subtracted in net profit. I will add back. So in my reconciliation, I will show this in the add part saying personal expenses. GST, it is a business expense. I will keep it as it is. Legal charges, business expense, I'll keep it as it is. When I'm saying keep it, it means I will not do anything. Audit fees, customs duty, business expense, I'll keep it as it is. Loss on sale of machinery is a capital item, part of capital head. So I have to remove it from PGBP. So in the net profit, it is already subtracted. So to nullify the effect of this, I will have to add. So in my reconciliation, I'll show this as add. Now coming to administrative. Now by the name, it is clear that it is a business expense on administering the business. So it is part of PGBP. However, there is one adjustment, we'll consider that. Now what does the adjustment says? This administrative includes rupees 10,500, which is not allowed as per some provision. Now you don't know this provision, I know, because that we are yet to study. That is why I said, this is not your real exam problem. This is only for giving you a practice of how you solve PGBP. Now the only difference between this and exam sum will be that in exam sum, all these things will not be given so straightforward. They will be giving you the whole adjustment like a story, and you have to decide whether it is allowed or not allowed under any of the PGP provision. But that after we study that, those sums will be later. So administrative expense is including expense of 10,500, for which some condition of PGBP is not satisfied. Hence, PGBP says, sorry, I cannot allow this amount as deduction under section 40 clause A. Now, here comes the challenge that this expense of 10,500, which is obviously included in this. So, sorry, not this, which is included in this. So it is already subtracted while finding this 2,000, 2,13,000. So in 2,13,000, it is already subtracted. So what I need to do is to nullify the effect of this, I will add. I'm just writing here that I will have to add 10,500. Reason is 40 clause A. Correct? Interest on capital, as we discussed earlier, not an expense at all because you are a proprietorship. So paying interest to yourself cannot be an expense. Bad debts, it is a business loss, and we are presuming because it is debited, it means it is business bad debts. It is also allowed as deduction. Now we considered all these adjustments. Last adjustments, which is the adjustment which is left is what it says, there is an expense of 9,000 which is allowed as deduction under business head. So business head allows this deduction. They have also mentioned the section. So as per the provisions of income tax PGBP head, you are eligible to deduct this. However, for some reason, they have not considered this in your accounting P&L. Now, this is that item which is not in P&L, but which is to be considered in PGBP. Now, if it is not in P&L, it means there is no effect on the net profit which you have taken, but you have to give some effect of it in PGBP. Now, what is the effect? It is an expense which is allowed. So if it is an expense which is allowed, so what now we are going to do is, yes, very correctly pointed out by many of you all. Anil, not correct, beta. Yes, very correct, everybody. Okay, now you are correct, Anil. Very good, everyone. So you all have rightly pointed out this, that I will subtract 9,000 in the reconciliation, staying same name. What is the name given? It is an expense under section 35. So I have to write it here just for your reference. I will write it in the less column saying that expense under section 35 not debited to accounting P&L. So I'm going to subtract it. Right, students? Yes, very good. Mustafa is asking, sir, just a quick question. If it's as you say, case study type question, so we have to write expense and income name and section number in which it can add or less. But if it is case study type question, in case study, you have to only tick or select the correct option out of the 4 options given, because in case study, your question is an MCQ format. So in their case, there is no place where you write any of these section numbers. You have to only select the answer right or wrong. This section numbers and all this working, you will be showing when it is a solving question and when you will be required to give the computation. Only then you'll write everything like this as per depreciation, as per income tax provision, or under this section or under that section. This you will be writing only in the computation sum, not in your case study type of question. Right? Anil is asking, sir, whether this format of PGBP remains same for company. That is what is important. Why we follow reconciliation format? Because reconciliation is applicable to all type of sums wherever you are computing PGBP, either as a part of comprehensive sum, then this is a working note, whether it is for company assessee, whether it is for individual assessee, firm assessee, for everyone, this is the only and the accepted format. Understood, beta? Clear? Excellent. Sir, how much inform is to be presented while solving? Understand, beta? I explained this in the previous class also, that when you are doing anything in tax, let us say this is a working which we are doing in tax, or for that matter, now I'm broadening this answer, any law subject. So it may be audit, it may be law, it may be income tax, it may be GST, wherever laws are applicable, you should give the justification either in the working itself, like I'm writing in bracket as per section this. So I've given the reason why I'm doing this. Or below this working, you have to write notes. In that note, like how we are discussing, you'll put it a sentence that since this expense is not allowed under income tax, this section, because of this reason, hence added. So what you have done in the working, you have to inform. Perfect, beta. Shraddha. Okay, excellent. Tiwari madam, I again forgot your name. Please mention your name so that I can address you with your name. I'm just not able to recall you had mentioned in the last class also. Yes. So students, I hope this is clear. Have understood. Let us proceed. So I come back to my notes. This is what we started discussing in the previous class. That is applying PGBP provisions. Now, when you say applying PGBP provisions, it means what? Now, PGBP provisions are on both sides. So you have the income side provisions, you have the expense side provisions. Now, in the income side provisions, you will be required to check three sections because there are only three sections dealing with the income side. What are those three? 28, 41, 43 CA. What does 28 says? It says that we will allow all those items in PGBP as revenue, as income, which are either directly arising from your business or indirectly arising from your business. So directly will cover your business receipts like fees, freight, room charges, food bill, sales, whatever is part of your business. Indirect will cover miscellaneous, discount, commissions, scrap sales. All these things are indirect. I'd ask you all to read the list. I'm expecting that you are reading the list. I'd explain that orally while explaining this, but if you read the list, it will be of great help. In the list, you'll find some special incomes, which the law says you will include it in PGBP head as per section 28, like compensation received for loss of business, then salary remuneration received by partner, interest on capital received by partner, right? Non-compete fees. These are those special incomes which are to be considered in PGBP as per section 28. Then the second section 41 dealing with PGBP head income is covering what? It is not covering income per se. It is basically the reversal of past entry. What is that past entry? In the past, there was some expense of which you had claimed deduction. Now, it may be an expense or it may be some business loss. And you had claimed the deduction under income tax PGBP head. So, if that deduction is allowable under PGBP head, so in past, something like this, you have debited that in your PGBP P&L just for visualization. So debiting in PGBP P&L means allowing as deduction. So you have subtracted it in your PGBP income. Now in the current year, if this amount is reimbursed, paid back to you, recovered by you, so what we have to do is this debit we have to nullify by credit. So this is the logic of section 43. So the expenses or losses which were earlier allowed as deduction under PGBP, if they are recovered, reimbursed, received by you in the current year, section 41 says treat them as PGBP income. So the second item or the second provision which provides for what income is to be considered in PGBP is section 41. Understood all? Great. Then we went to the third section of PGBP income. That is section 43CA. Now this section 43CA is dealing with what? It is dealing with a particular case scenario, that is where the assessee is a builder or a real estate developer. Now if the assessee is a builder real estate developer, what is the business of the assessee? The business is selling properties, either which is constructed by them or which is purchased by them. Now these properties may be land or building. Building means flats, shops, offices, whatever. Now, when you are in this business, you are called as the builder or real estate developer. But there is a possibility that you are not in this business, still you are selling them. So that is why, depending upon the nature and intent of doing this sale, if it is your business to sell land or building, the income is covered under PGP head. If it is not your business, it is covered under the capital gains head. Correct? Now, the main part. What is the main part? In either case, whether covered under business head or capital head, the provisions are same. Only since the heads are different, they are provided in different sections. So section 43CA, which is the present section we are discussing, is for PGBP head provisions. 50C is for capital gain head provisions. What does these provisions say? Now, we are parallelly discussing both the provisions because both the provisions are same. Now, what does the provision says? The provision says that whenever you are selling any mobile property, land, building, in that case, why determine your business head income under PGP head or your capital gain income under capital head? What will be the value that you will be considering? So basically, in this format, we are talking about this item. What value you will consider here? Now, as per section 28, it is your business sales, but the value is to be determined as per 43CA. So what will be your value for this particular sale? 43CA says that for determining this sales value, you will have to consider two figures. What are those two figures? One is the agreement price that you have recorded on your agreement of sale or the sale deed. And second is the value given by the stamp authorities, which is called as stamp value or value as per stamp duty. So we have two values. One is your agreement price, agreement value, and the other is stamp value. Now, what does the provision says? There are three possibilities. Possibility one. The first possibility is you have shown 100 rupees in your agreement. Stamp value is 80. So first possibility is your agreement, your sale price is higher. Then both provision says for the purpose of computing income, you will consider your agreement value. Second possibility, agreement value is 100. Stamp value is slightly higher. So it is 105. Now the moment stamp value is higher than your sale value, both the provisions say that you make a calculation by adding 10% to your sale value. So derive this figure, which is 110% of your sale value. So in my example, it will come to 110. Again, compare this 110 with your stamp value. Now, if this 110% value is higher, then the law says, again consider your sale value only as the value for computing income. But the third possibility, where again, as compared to your sale value, agreement value is higher, you again added 10%. So you got 110%. When you compared this 110 with the stamp value is still higher than the 110% value. Now the law says take stamp value for the purpose of computing your incomes. So this is what is the provision saying. Correct? I hope this is clear up to this point, because in this there are two technical pointers which today I would like to discuss. But before that, up to this point, is it clear to everyone? Just give me 1 minute. Okay, excellent. Anil says stamp duty value should not exceed 110% of agreement value. Right, sir. In that we have to consider stamp duty value. We have to apply test of 110%. Yes. So you have to check 110% with stamp duty value. If stamp duty value exceeds that, then stamp duty value has to be considered. So 10% is the margin up to which your agreement value and stamp value can be different. In that case, agreement value will only be taken. Nagaraja, beta, that is what is the other technical point I'm yet to come. So that is what I said. Now, there are two technical points to be discussed. But first, the basic provision you should know, because many times the adjustment will be only covering this much what I explained. Technical point, maybe an additional point if required. So every time the question in the exam will not cover everything. So in a particular section or provision, there could be multiple pointers. Exam sums may optionally cover those or not. So first, this is the first type of exam problem which you may be required to address. Excellent. So people are saying they are clear. Yes, Disha, thank you. Maybe every day I'll request that whenever we start, you just post your name so that I'm comfortable addressing you with your personal name. Now, what are the two technical pointers in this? Now, the two technical pointers is, one is giving you a third value. So you already have agreement value, you already have stamp value. Now the third value is value as per valuation officer. Now what is this value as per valuation officer? This value as per valuation officer is a third value. Now where this value is to be considered, or where this value will be considered, whenever as per law you have to take the stamp value. So in the third scenario, there is a stamp value which has to be taken as per the provisions of law. Now, as an assessee, you are not happy with this because you end up paying more tax, and you feel that genuinely your value, agreement value, is correct. So the law gives you an opportunity that in case, as per this provision 43CA, or in case of capital gain 50C, you are required to take the stamp duty value, but you consider that genuinely your value is correct and the stamp value is abnormally high. So the provision says, in that case, you may ask the assessing officer, that is your income tax authority, to refer your case to a specialized officer called as the valuation officer. So I'm sure you all would be knowing this, that there is a special profession of valuers who are officially, formally, professionally hired for valuation of different properties. Now, you approach your officer, ask him saying, ki, sir, I'm not comfortable with the stamp value, it is exorbitantly high. So you refer my case to valuation officer. When the case is referred to the valuation officer, the valuation officer will now compute the value using various workings, calculations that you study in your FM subject, and he will give you a value. Now, when a valuation officer gives you a value, what are the possibilities? First, valuation officer's value is 150, which is even higher than the stamp value. So the first possibility is the valuation officer's value is higher even from the stamp duty value. Then the law says, don't worry, we will take stamp duty value only. So where the valuation officer's value is higher than stamp duty value, you take stamp value only. But let us say the valuation of the valuation officer is 120, which is lower than the stamp. So the law says, okay, anyways, you were also claiming that your value is lower and the valuation officer has given a value which is lower than the stamp value. So let us take that value. So the simple rule given is that in case you feel the stamp value is exorbitantly high, you can approach the authority, ask them to refer your case to a specialized valuation officer, and then depending upon what is the value given by the valuation officer, if the valuation officer's value is even higher, you will not consider it. You will keep the stamp value as the answer. But if his value is lower than stamp value, then you are given the provision that you will consider valuation officer's value for the purpose of computing your PGBP and CG incomes. I hope this is clear to all. Mustafa, obviously, the very first step is you determine residential status. From that, you determine which incomes are taxable in India, and only for those incomes you do computation. So it may be salary, HP, PGBP, any head income. That is why the first provision in the law is also residential status. So you start from residential status and then you come to computation. Excellent. It is clear to everyone. That's great. Now I come to the second technical point. Now this second technical point is many times asked in the question where they want to make the paper or this adjustment in the paper technical. Now, what is that? Now, for all these uh, workings or in both these sections, you have to compare your agreement value with stamp value always and then decide which value should be taken. But when you have to compare with stamp value, keep in mind, students, stamp value is fixed by the government, which I explained last time, the story behind it. And this value is also revised periodically by the government. Now, this next technical point is if there is a revision in stamp value. So now you have two stamp values, old one, new one. Which one you will consider for this comparison? Because see, here you have to compare the stamp value with your agreement value to decide whether your agreement value has to be taken or the stamp value has to be taken. But if there is a change in the stamp value and there are two stamp values, old and new, then out of both, which one is to be taken? For this, again, let us have a story. So let us say Mr. Anand is selling his Anand Nivas, which is a bungalow, to Mr. Happy. Now, on, let us say today's date is 27th November 2025. They agree. So between them, a deal is struck. They have agreed that yes, we will sell this property. Now let us say they have agreed to sell this property for 2.5 crores. Anand has agreed to sell it to Happy. Happy has agreed this. But Happy says, "Hey boss, 2.5 is a huge amount. Today I do not have the whole amount ready, and that is a practical thing. So either I will require loan or I will have to liquidate some of my mutual funds and other investments. So give me 5-6 months and we will close this deal, let us say somewhere in April 2026. Anand says, yes, I understand how things happen. So I'm okay. Now in this case, Anand says, ki boss, I will wait for you for 5-6 months, but what is my assurance? Because if tomorrow you do not turn up in this period, I will also not be able to give it to anybody else because I have already agreed with you. So what they do is they enter into a temporary agreement, which is called as agreement to sell now on this date. And there is always an advance or token. So let us say there is a token given by Happy to Mr. Anand of rupees 20 lakhs. So with this, you have agreed, we have concluded that yes, we will do this transaction. And as a confirmation, you have given this token. Now, in future, let us say in April 26, when all arrangements are done by Happy, we complete this by entering into a sale deed. So sale deed is the main conclusive document, which is considered as the final document for this sale. And on that date, balance payments are done. Now, see, the balance payment may be done during the period in installments, like as Happy is arranging, he's sending, that is okay. But your agreement is concluded on the date of sale deed. Now, in this example, there are two dates. The date on which you all agreed that you will go ahead with this transaction, and the date of sale deed, April 26. Now, your sale value is finalized at 2.5 crores. Now, what has happened? Between these two dates, the government has revised the stamp rates. On this date, the stamp value was 2.45 CR. Now I'm talking about the stamp value. And on this date, it has been made 3 CR. Now, what is the point? We just saw that for determining the final amount that will be considered in PGBP or CG, you have to consider your price with the stamp value. Now, your price is fixed. Your price is 2.5 crore. But whether to compare it with 2.45, because in that case, 2.5 will be accepted as the answer, or it has to be compared with 3, because in that case, even if you add 10%, still this is higher. So 3 crore will be taken as the answer. So your answer can change drastically. The computation of income can change drastically. In this case, which value of stamp has to be considered? That is the point. This is where the second technical point comes. What does this second technical point says? So the second technical point is saying, कि भाई, for us the date on which you all have agreed is the conclusive date. So we are ready to take this date's stamp value, which will be this. Because you all have agreed on that date. Okay, na, formalities will take time. You will do the final document, the sale deed at a later date. We are okay. But we understand that since the transaction has happened on this date, we are ready to take this date's stamp duty value. But then what is the proof that you all have done this transaction? So they say we will see the token advance. Now you have given token to the seller of 20 lakhs. Great. But I want to see the medium through which it is given. If it is given by cash or by bearer check or even by a crossed check, then we will not accept it. But if the payment is done by account pay check or the online or the banking mediums like UPS or through scanning of QR code or through online transfers using payment gateway, debit card, credit card, internet banking, or by going to the bank and using RTGS NEFT. Any of these mediums are used, then we will accept it. So now to determine which date stamp value is to be taken, the date of agreement or the date of final deed, which is registered, they say our preference is the date on which you have agreed, provided the advance token, whatever is paid, should be paid by account pay check draft or by banking channel or by online medium only. If that is done, this date stamp value is accepted. If that is not done, the token advance is by way of cash or by way of cross check or bearer check, then we will take the other date stamp value. This is the second technical point relating to which dates stamp values to be taken. Is this clear to everyone? Yes. So is it clear, students? What is speculation business point beta here? Yes, Mustafa, what is speculation business point here? Speculation business point beta, but here how it is relevant? It is a separate point in itself. You are saying speculation business point here. In this stamp value point or in this 43 CA, there is no speculation business point. Speculation business is altogether a different concept in PGBP. I have not yet come to that special point. Navneet says, sir, whether agreement to sell has been made, but if paid in cash, will it not be considered? No. So see, agreement to sell, they are not considering. That is a parallel proof that you have agreed, but for determining the date of stamp value, they are only looking at the payment. I'll tell you why. See, because let us say, understand this, the logic of this. Why they are asking for payment and that also through approved mode? Because if genuinely, let us say your transaction happened in April 26, let us say it happened in April 26, but you all know this, here a backdated transaction, if we can show the benefit is stamp duty was less. So what people will do, even though they have done transaction later, they will try to push and show the transaction at a previous date. How? By simply saying that the payment was made in cash or by simply making a kacha agreement which can be done any time of any back date. So that will defeat the intention of law. So the intention of law is we want a concrete proof, and concrete proof is bank entry. That also through a proper mechanism which will prove or which will justify that there was no other possibility it was actually agreed on that day. That is the logic better now. Fine. Yes, but online, see, there is a list that you'll study in 43C also and in another section also that we are going to study. So that list is there. It covers everything, UPI, etc., etc. Tisha is asking if the advance paid in cash, then we will take 3 crore. Yes, beta. So if advance is in cash or by a bearer check or even by cross check, then that date's stamp value is not taken. We will take the stamp value of the final sale deed, which is registered. So in my example, it will be 3 crores. Anil says, sir, if the advance payment was made through cash, then we have to consider stamp duty value as on date of agreement. But agreement means the final registered sale deed, because the agreement may have happened on the first day also, which is the Kacha agreement, which is agreement to sell. So let us not use the word agreement because that may be confusing. So if the advance payment is made by cash or by bearer check or by cross check, then you will not consider that day stamp value. You will consider the stamp value of the last day. That is when the sale deed is registered. Correct? Okay. Excellent. Great. Great. So Mustafa, please check. There is no concept in this provision of speculation. Speculation business is there, which is altogether a different concept provision that we will be dealing with separately when need be. Correct? Okay. Let us proceed. Okay, so now everyone is clear with this. So students, we are here. We are dealing with the PGBP provisions. And right now what we have studied is the provisions of the credit side of PGBP. Now, once we have studied the provisions of the credit side, the next part is provisions on the debit side of PGBP. Now, as I had mentioned in the previous class, section number wise, it is between 30 to 43, but actually it is 40 plus sections. But you can understand, remember, and apply them by following the method which I am going to explain to you. Use that approach method. It will be easy to remember and recall all the provisions. Now, I've divided the debit side provisions into two categories. What are those two categories? When you read all the sections of debit side means relating to what expenses can be allowed as deduction in PGBP income. So there are broadly sections 30 to 37, which again covers 25 plus sections. Though number wise it may appear 6, 7, but actually it covers 25 plus sections. Now in this case, for this particular part, when you read all these 25 plus sections, basically what those sections are doing, those sections are basically covering a list in different sections of various expenses. Okay, we will allow this, we will allow this. So they are covering different expenses. And then they are saying that for each expense, you have to satisfy these conditions. If you satisfy them, we will allow them in business as an expense. So simply, all these sections 30 to 37 are giving you a list of expenses. And for every expense, in every section, they are giving you conditions. You satisfy these conditions, I will allow you deduction. Now, interestingly, reading those 25 sections separately is of no use when you know that all these sections are basically addressing the same conditions. So instead of reading it expense wise or section wise, why not read it the condition wise? So there are broadly 4 conditions in every section for allowing a particular expense as deduction in PGBP. I have called those four conditions as the golden rules. So when I'm saying golden rules, it is the four conditions. Now, interestingly, you will say, sir, if all the sections are covering the same four conditions, why did the law not make a single section for all expenses and give the four condition at one place? Why to make these sections and why it is continuously getting added? This list is growing. The answer is they made different sections because one, they wanted to list down different expense. Plus, for some expense, out of four, they wanted to relax one, two, or three conditions. Means, generally the rule is satisfy all the four conditions, I give you deduction. But for some expenses, there is an exception. What is the exception? For some expenses, it is saying don't satisfy all four, satisfy these three, or any other combination, or satisfy two, again, combination of two. So, why you have so many sections? Because in different sections, for different expenses, they have asked you to satisfy either all four, or three, or two, or one of the expense. So, how we are going to study those 25 sections here between 30 to 37? We are going to study it separately, expense wise also. So the entire act is also covered, but that will be very academic and it will be only useful as theory. But for all practical purposes, that is for solving your exams. So you should be able to understand it from the perspective of how to apply these 25 plus sections. So what we will do is we will study these sections in the form of four conditions. So you will see here, I have made four conditions and they are very simple and basic conditions. First is only those expenses can be claimed as deduction which are related to your business. So this is also matching with our first step one, which is the step of segregation, that we only keep those expenses here which are part of business. So that is related. Second condition that is emerging is these expenses should be not of capital nature, they should be of revenue nature. Third condition emerging is they should pertain to that particular year of which computation is being done, so that you are not taking any past or future year's expense. And then the last is the expense should be such that it is not prohibited or forbidden by any law. Why? Because that expense is itself an offense. Like, as you can see, giving bribe. Now, bribe is an expense for a business, but is giving bribe legal? No. So why should I allow? Because if I allow bribe as a deduction indirectly, I am legalizing bribe. So the fourth condition is that expense should not be something which is forbidden or which is treated as an offense under any other law. Now, as I said, all these 25 plus sections dealing with all the expenses between 30 to 37 section numbers, these are broadly covering these four conditions only. But in some sections, for some expenses, they have relaxed one or two or three of these conditions. So how we will study? We will study them as exceptions. Exception means that the general rule is, for example, the first condition is your expense should be related to business. But what is the exception? For some expense, they have relaxed the condition that, okay, this expense, even if not related to business, we will allow deduction. So this will help you in understanding and applying them in a practical question. So that when you read the practical question, you'll read the name of that expense in the P&L debit side. You know that, okay, for this expense, even if it is not related to business or if it is not revenue, etc., we get deduction. So it will help you in applying them in a much better manner when you are dealing with a practical or a case study question. So We study those 25 plus sections, but in the form of this golden rules, that is those four conditions which I've already read out, and in which condition what expenses are an exception. That is, for those expenses, you need not satisfy that particular condition. Still, I will give you deduction. Anil says, sir, all these four conditions are common, but few additional conditions. See, that is obviously going to be there, but those additional conditions are not affecting the practical part. They are just theoretical conditions. Definitely, those have to be studied. That is why, Anil, I said we will be studying them again separately after this, because right now my approach is to prepare you for handling the practical and the case study questions on this. For that, so we are looking at the subject from this perspective. Then academically, we'll run through all the expenses list which are there, which is there even in your module. Viral is asking, sir, if advance is paid as per my banking channel, so we take stamp value as on the date of agreement. Yes, beta, correct. That is what is the point. So if you are paying the token advance using the proper banking channel, then agreement value of the date, stamp value of the date on which you all agreed, and you paid the advance. So basically, you take the date of the advance payment. That date will be taken for deciding the stamp value. Ishwarya is asking, sir, how these provisions will affect reconciliation. But so from these provisions, now you'll understand that whether that expense will be allowed or not. Now, when that expense will be allowed, only when you satisfy the conditions. So if you're not satisfying the conditions, so the expense will not be allowed. And if it is not allowed, you will have to adjust it in reconciliation. Correct? Like how we just solved a sum. In that, there was one point that this is allowed under 35 section. There would be some point that this is allowed or not allowed under 36, 32, 30. So this is how it will affect the reconciliation. So with these sections or with these conditions known, you will be now able to decide that as per PGBP, whether that expense will be allowed or not allowed. If it is not allowed and it is already debited in P&L, so you know you have to do adjustment in reconciliation. Correct, beta? Should we proceed? What you are saying, it is called as decider right. What is this decider right, beta? There is no such thing in the law. You can definitely use a terminology like this, but law has not used any system. Okay, Virali is saying, sir, break. ठीक है, I can understand. ठीक है, चलो. So I was going to give after 5-10 minutes, but ठीक है. Since we are going to start a new part, let us take a break. So students, we have our 15 minutes break. You all can refresh, you can take breakfast and come back. Thank you. Okay, students, let us continue. Mustafa Bada, you can read everything from the module, whatever done, not done, because it will be covered today or next class. Because see, I do not go in the flow of the section. I go in the flow of the uh, my notes, or you can say the approach I have devised. So I cannot open the module and mark each and go to each and every page to tell you that whether this is covered or not covered, beta. So I request that you read the module. Whatever you are not able to understand, just mark. Okay, this is not understood. Whether covered, not covered, should not make a difference. Fine, beta. Okay. So students, now we are on the point of golden rules and the exceptions where these golden rules or the conditions need not be satisfied for getting that deduction under the business head. So first condition, first rule is that the expense should be a business expense. So in simple words, it should be related to business means it should be a expense of business, not of personal nature, not of any other head. First simple point. Now exceptions means certain expenses we are going to allow even if not having relation to the business. Now this is important. What are those expenses? And another point, why? So I'll answer both. First, we see what are those expenses. So basically, there are three expenses: family planning, scientific research, and donations. Now, these three expenses are allowed here, even though having no relation to business, because they are of national eminence. They are for a purpose which is for any developmental work, any research work, or any welfare work of our country, of the society. How? First expense, family planning. Now, what is a family planning expense? We all know India's biggest asset and also equally a liability is our population. Now, it is better, but there was a time, some 10, 15 years back, when the population was increasing at a very high rate. Today, we have crossed China and all, that is okay, but the rate of increase is today not that high. Why? Because looking at that particular situation where our population was, we used to read or that it is exploding. So it was increasing at such a high rate that it would have created a lot of problem, stress on the economy, on the infrastructure, which is already we are seeing. To avoid that, the government decided to run a drive by which the government will push, will promote, the government will push, will promote. Second, students. So, through some ad campaigns, through a specific drive, the government started pitching, inculcating this, that this is a problem for the country as a whole, and we need to take some suitable measures to control this population. Now, when the government was running these drives at its end, which was in the form of putting posters, running radio ad, television ads. I'm talking about 10, 15 years back when internet and all were not in so much use and people were not having access to internet on their phones. So government had come up with such type of drives. To add to this, the government told companies, so this deduction is allowed to companies, that since you are having at one place workers which are in huge number, in thousands, then we will give you this expense as a deduction, where you also have to do the same thing. You have to promote this point that why family planning is required, what are the disadvantages to our country, what is the disadvantage to that individual worker and his family, and also to explain them how they can properly do family planning. So what government was doing at the government level, they brought the same thing to the company. So what company would be doing? Company would be organizing sessions, lectures, would be distributing some pamphlets. So all these is the expense on family planning. It is promoting the family planning amongst the employees, and this expense is allowed only to companies. So first expense, again, you'll understand it has nothing to do with business because it is not required for running your business, but it is for a national cause. Hence, the government is extending this deduction, but only to companies. On similar lines, the second expense. Now, what is scientific research? In accounts, we normally call it as R&D. Now, this is business expense also because many times business do this expense for their business benefits, because for being in the competition or for exceeding the competition, the businesses require to spend on different types of R&D. That is anyways allowed. For that, we do not require this exception. This exception is given that where some research is done by some approved scientific research association, college, university, organization, national laboratory, and this research may not be related to your business, but again, it is in the national interest. Let us say Bhabha Atomic Research Center is doing research. ISRO is doing so much of research. There are so many other organizations, bodies, which are doing research in different fields. Somebody may be doing in agriculture, somebody may be doing in cyber, somebody may be doing in your different types of what it is health related things. Now, these researches are not related to your business because you're not into that business, but it is in national interest. So government has approved some bodies. If you are making payment to them, if you are giving them some money towards this research, so again, it is like a contribution or donation. Even though that research is not related to business, we will give you deduction. So within research, if you're doing business research, anyways, it is covered in the condition itself. There is no question of going to exception. For exception, what is required is the person to whom you are making this payment should be an approved scientific research association body, etc. So if you are giving it to anyone who is not approved by the government, or you are yourself doing a research which is not related to business, deduction is not allowed. So for this exception, compulsorily the payment is made to outsider, not the research is not done by you. And secondly, it should be only to outside approved scientific research association body. So here we will allow deduction even if the scientific research is not even if it has no connection with your business, we allow it. Correct? Now see, there are changes between new scheme, old scheme, but right now I'm not unnecessarily going into that because that will complicate the point. Let us first at the technical level understand it. Then we go to the scheme level, whether under new scheme, old scheme. That anyways is there on the screen also. So right now, first understand in principle the concept and the provisions. Now here, the best part for you that has happened is few years back, this particular point, as you can see, had different percentages of deduction. In fact, there were many more, 200%, 175%, 125%. So it was slightly challenging this part because you are also required to learn with the names how much percentage of deduction is allowed. But now the best part for you today is the section has become simple. It simply says, if you are making payment to an approved scientific research body, even if the research is not related to your business, we will allow you complete deduction. So the challenge of remembering the percentage with names has gone. So it has made it more simple. Okay. Now comes to the third category. Now, in third category, donation, you have to understand few things. If it is simply given as donation, it is not allowed. So merely donation, not allowed. Second, donations for which already a deduction exists in Income Tax Act, but some other chapter under some other provision, which we call as deduction under chapter 6A. Now, this is the deduction allowed from the gross total income. That will again not be allowed here. What will be allowed here is only where you are making donation, which is covered under the PGBP head under section 35. Now, again, what are those donations? Those are the donations which are for promoting some national cause. And two important ones which are regularly given in the questions are donation for agricultural extension or donation for skill development. So we all know government is working very aggressively on the skill development aspect. You will find in every city now, you have a skill development center being run by the government, and there are so many skill development programs and schemes by the government. So these are for national cause, and for them, the deduction is allowed if you are making a donation. So for the purpose of PGBP head, even if you make a donation under these sections, which is part of Income Tax Act only, PGBP head will not allow you deduction because these are not deductions for PGBP head. They are deductions from gross total income. So you have to be clear with this, that gross total income deductions are allowed separately. So even though part of Income Tax Act, they are not covered here in PGBP, right? Only where donations are under section 35, and these are the two major ones, you can take deduction under PGBP. So first condition, expense should be related to business. Three cases where even if not related to business, we allow deduction. One is where it is for family planning amongst your employees, promoting family planning amongst your employees, but this is allowed only if you're a company. Second, where you are making payment to outsider, very important, outsider, and the person is approved. Third, where you are making donations, but only to those which are covered in section 35. Three cases, deduction allowed, even if the expense is not related to business. Correct? Second condition. Now, since business head is a revenue head means it is not like capital gain where we are taxing or we are covering capital items. It is purely a revenue head. So we will also consider only those expenses which are revenue in nature. In other words, capital is not covered. But again, exception. What are those exceptions? First, the same family planning expenses. Now, let us say you as a company are incurring this expense for promotion of family planning amongst your employees. Now, if you have incurred revenue expense like printing of pamphlet, etc., it is fully allowed. Anyways, this was covered in above point also. But if let us say you are incurring a capital expense. Now, what can be a capital expense? So the company has purchased a projector, or the company has made a small hall or a room exclusively for conducting seminars, programs, so that in batches regularly they can train their employees, they can inform them, they can give them more relevant facts about the need for family planning. So for that, they have incurred some capital expenditure, that is expense which is capitalized in book. Now, where any such expense is done, the law says we will still allow you deduction. Why? Same reason, national cost. The only difference is this deduction will be spread over 5 years. So it will be apportioned over a period of 5 years. Every year we allow 1/5. So that is what is the point. So family planning expenses, revenue allowed full, capital also allowed, but in 5 installments. So the year in which you incur, you take 1/5. Next year 1/5, third year 1/5, so on up to 5 years. Important. Again, I have not repeated here, but by default, the above condition continues. This is allowed only if you're a company. Then comes scientific research. Now in scientific research, the above point was where you are making payment to outsiders. There, even research not related to business was covered. Now here we are covering in-house scientific research. Now what is in-house? You have established a scientific research facility, a laboratory, a facility where you are yourself doing the research, which is called as in-house. Now, when you're talking about in-house research, it should be related to business compulsorily. So, not related to business research is allowed only when you are making payment to Bhabha Atomic Research Center, ISRO, or any such outside approved bodies. There, any research may be part of business or not allowed. But where the research is in-house research, in that particular case, you have to ensure that the research which you are doing in-house is related to your business. First point. Here, the benefit is if it is in-house and related to your business, we will allow you deduction even for capital expenses. And this capital expense is allowed full, no need to do 1/5 or anything. Plus, very important thing. See, generally, also I allow you deduct while computing your PGBP income, but how in the form of depreciation. So you take some part of it at some fixed percentage as depreciation. But here, when I say I give you deduction for capital expense, it means here you are not taking depreciation, you are debiting the full amount of the capital expenditure in PGBP P&L. That is what it means. So when I say expenses of capital nature are allowed as deduction under PGBP, so just visualize you have debited the full machinery value in the P&L. Which P&L? PGBP P&L. Correct. Third case where capital expenses are allowed is, again, we are going to study a list, which is a list of some specified businesses. This list is given under section 35 AD. So if you are running a specified business, which is covered under 35 AD, and you have satisfied the conditions over there, then for those businesses, again, the law says we allow you capital expenses in those businesses. Means in those businesses, you can take deduction of building machinery immediately and you will not go for a depreciation. So when I say capital expenses allowed in all these points, it means you will not be claiming depreciation. And in second and third point, you are claiming 100% expense in the first year itself by debiting that full amount to your PGBP P&L. So Kuldeep Beta, this is what I'm repeating. So for all these three expenses, you will not be claiming depreciation. This is what I'm repeating, Kuldeep, right? So these are the three exceptions or the three specific expenses where the law says don't take depreciation, take the entire capital expense deduction. Here in first case, it will be allowed in 5 installments over 5 years. In other two, it is allowed full immediately. Then coming to the third condition. Since we compute income every year, so you need to bifurcate that, okay, this is related to this year, this related to any future year, this related to any past year, so that you do not overlap things. So what is this third condition? Again, a very simple and logical one, that consider expenses which are of this year. Do not consider expense which is of past or of future. So the general rule is only current year expense, that is the relevant year of which you are doing working, that should only be taken, which is logical. Again, exceptions where the law says we even allow future expense today or we even allow past expense today. Now, this is interesting. For future, there is only one expense of future which is allowed today. That is, if you have created a provision. See, provision is always for future year expense. So if you have created a provision whereby you will be actually incurring those expenses in future when the employee retires, you'll incur the expense of gratuity. But if you are creating the provision, then we will be studying this, a special restriction under 40A7, which provides that if you satisfy some conditions, restrictions over there, we will allow the deduction on provision basis. So the general rule is you will not take deduction of any provisions. I repeat, general rule is you will not take deduction of any provision except provision for gratuity, that too subject to these conditions, which we are yet to study. So this is only one future expense which is allowed to you today on provision basis. Now comes the second category, which is past expenses. Now this is interesting. What is past expenses? So the amount is spent by you in some earlier year. In some earlier period, you have spent this amount. Today, you are claiming the deduction. Now this is again, as per the general rule, not allowed, but again in specific cases, it is allowed. What is that? Now this point is linked with the previous point where we studied above that for a company, capital family planning is allowed over 5 years. So over there in the above point, we studied that for family planning, even capital expenses are allowed. And here what we are studying is that that capital expense is allowed even if it was incurred in past. Why? Because the law itself says you will take it in 5 installments. So let us say the expense was incurred in 2022-23. Now that past year expense, 1/5 is still allowed in the current year because the 5 years is not over. So 22, 23, 1/5, 23, 24, 25, 26, 26, 27, 27, 28 will allow in these 5 years. So here we are claiming one past year expense in the current year. Why? Because there is that express provision. Similarly, where you have incurred some preliminary expenses. Now, preliminary expenses are again expenses of past where the business was not in existence, it was not yet commenced, but we incur these expenses as a preliminary means before starting of business, and then after incurring these expenses, you make the business ready and you launch the business. So these are those expenses which you have incurred in the past. But first is expenses only relating to research. Now, again, we study this whole in detail when we go to the scientific research category. So all the above points which you are studying in every conditions exception, all are relating to scientific research. Why? Because the country wants research and development. Country is benefited at large when the country is doing research. So the government wants to promote research. So all these benefits are given for scientific research. So we'll be studying that these scientific research expense preliminary will be allowed provided they are incurred in 3 years period before commencement of business. So if you are incurring any older expense, we will not allow it. So these are those restrictions, conditions that you study. So preliminary scientific research expense is the second expense of past, which we are allowing in the current period. Then comes general preliminary. So above was a specific preliminary only dealing with scientific research. Now, what about the general preliminary that we study in accounts also, that you have incurred preliminary expense before start of the business? So there is a specific section 35D which allows the same. Similarly, when a company is formed by amalgamation or demerger, so you have a lot of legal formalities to be done, you have valuations to be done, you have different compliances of SEBI, of your company law that has to be done. So for this, you hire people, you appoint different CAs, company secretaries, and different lawyers who are handling this, and you are appointing a chartered accountant for the valuation part. So all this is your expenses, which is incurred again before starting of this new entity which gets formed by amalgamation demerger. So all these expenses on amalgamation demerger is also in the nature of preliminary. So I have put it here. And then there is one more expense, that is VRS. We all know that is when you are asking an employee to retire before the retirement date, you have to give a compensation. That is the VRS compensation. So why I have clubbed all these three? So one is general preliminary, one is specific expense for amalgamation demerger, and one is VRS. So these are all allowed as deduction by taking 1/5. Now again, what will happen? This expense would have been incurred 2 or 3 or 4 years back, and you are still taking that installment deduction of 1/5. So again, this is a past expense allowed in the current year. Similar, another preliminary for a specific case where you are in the business of mining. The only difference is for them up to 10 years past expense is allowed because they are going to allow you expense, sorry, not up to 10 years past, but they are going to allow you expense 1/10 in 10 years. So the preliminary expenses incurred on mining will be allowed in future 10 years period. So You may have incurred some expense preliminary 7, 8 years back, but still you are getting the deduction because the law has spread it over 10 years. So these are those 4 cases where expenses incurred in past is, as per the law, allowed to be carried forward and claim deduction in the current period. So 1/5 capital portion of scientific research, then sorry, not scientific research, family planning, then preliminary scientific research, general preliminary, amalgamation demerger expense, VRS expense, and the preliminary relating to mine business. So these are those 4 scenarios which covers different expenses incurred in past but allowed as deduction even in the current year. Now, when it comes to E and F, these are very specific scenarios coming out of some other provisions of law, like here you read 40 clause A, here you read 43B. So I will not explain it now. When we study 40 clause A, 43B, alongside that, I'll explain this, right? Now, what is the fourth condition? So the fourth condition is the expenses should not be of such a nature which is forbidden by law or which is treated as offense by any law. Because if that is the case, you cannot claim deduction. So deduction will not be allowed of expenses which are by themselves forbidden. So examples of this which will be disallowed is bribe, payment to underworld, like maybe for protection money or something like this, which many times film personalities or big business personalities have to do, but they cannot claim deduction. Then penalties and offenses, penalties for offenses like smuggling, evading tax. So where you are paying penalties for any such acts which are regarded as offense, those penalties are also not allowed. So these are the expenses which will be disallowed. However, there is a confusion which students carry. So I have put a different portion here which I have called as allowed. So when you read this penalties for offense, which is disallowed, as a student, you just remember or catch the word penalty. And then any penalty given in the question, you will say it is disallowed. But that is incorrect. So I've taken this point separately. Where you are paying penalty, but in the normal course of business. Now, what is normal course of business? See, when you're running business, there could be breach of some contract done. There could be some conditions put upon you which you could not fulfill. There could be some other requirements under different laws which you could not fulfill. Now, please understand, students, not fulfilling any condition given under a particular law does not makes that particular act as an offense. Because see, the law agrees to this, that for example, if I've said that you take registration by 1st of December, now for some reason you missed out, you took it on 10th of December. Law will impose some penalty because you did not comply with the law. But by not complying with this provision of the law, it is not necessary that your act of non-compliance is an offense. It is non-compliance. It is, let us say, your mistake. But that mistake is not necessarily offense. So what is important to be understood here, students, is that you should not keep this word penalty in your mind to say that penalty given, I will disallow. No. So the point is penalties only for acts which are like smuggling, evading tax, which is offense, are only disallowed. But penalties which are incurred in day-to-day business, which happens not with the intent of defeating the law, but it happens like you had entered into a contract, but you could not fulfill the conditions of the contract. So it is a breach. And Contract Act, you all have studied, says that there would be liquidated damages or penalty. Similarly, you had taken some export benefit for which the government said that, okay, you do this, this, this. You miss some procedural conditions. So these may attract penalty, but those penalties are part and part of business and hence will be allowed as deduction. So the 4 conditions which is present, which you have to satisfy for every expense is that expense should be business expense of revenue nature pertaining to current year, and the expense should not be such that it is forbidden by any law. All 4 conditions satisfied, your expense satisfy 30 to 37 conditions. Section 30 to section 37 conditions. For some expense, one of these conditions, two of these conditions are relaxed, so those becomes exception. So for those expense, like scientific research, like family planning, you need not satisfy those conditions, still it is allowed. This is the position. Now, once you satisfy this, prima facie, your expense is allowable until it is specifically restricted or specifically disallowed by the Income Tax Act. So, first step in expense is you should satisfy the conditions. If you do not satisfy the condition, any expense can be disallowed. But once you satisfy the conditions, after that, your expense will be disallowed only if there is a specific restriction or disallowance. So now we will study those specific conditions or disallowance which will restrict you from taking deduction of an expense. Now in this, the first section is 40 clause A, which has two parts. I will discuss part B separately because it is slightly lengthy. It will require some 15-20 minutes of discussion. So I'll cover today small pointers, which can be covered in the remaining time. Now, what does first thing which 40 clause A disallows? It disallows direct taxes. So commonly you will find this that in your profit and loss, income tax is debited. Now, it may be called as income tax, it may be called as provision for income tax, it may be called as advance tax. So whatever is debited to your P&L pertaining to income tax, that is disallowed always. So Income Tax Act itself says income tax paid, payable, provision, outstanding, whatever you say is disallowed. Now, interestingly, not only income tax, the interest, the penalty also automatically gets disallowed, because if the basic tax itself is disallowed, then any interest coming on it, any penalty coming on it will be disallowed. That is the first disallowance for today. Second disallowance is when you are incurring an expense. Now, the law says we have no problem in you doing business with your relatives, with some specified persons whose list is given. Now, these are all those persons who are your close connects. Law says I have no problem. Like, let us say your brother is running some stationery shop. You can buy stationery from this shop, and that stationery expense is allowed. Or you have employed your sister in your own business because she is a qualified chartered accountant, very knowledgeable, and she could have worked in some other outside business, but she is working in your business, and like outside business, you are paying her salary. No problem at all. So what does this second restriction says? That if you are doing business transactions with your specified persons who includes relative and some close associates, we don't have a problem. Only thing that you have to ensure is that whatever expenses you are doing with that person, that expense should be up to the fair market value. So let us say, taking example of stationery purchase from my brother's shop. So he has given a bill showing rupees 48,000 for the stationery items I purchased. And when I take a parallel fair market value, I get 40,000 as the parallel fair market value of same items. Now, in this case, the law says, boss, here there is excess payment. Now, interestingly, had this expense been done with any outsider means who is not your relative or not your associate, we would have allowed the high payment also. Because there we don't have a problem, because there is no scope of tax evasion or tax adjustment. But when you're doing this type of transaction within your close circle, with your relatives, with your associate, there is a problem. This could be a measure of tax evasion by claiming higher expense in your books. So the law says we will disallow. But interestingly, they are not disallowing the full 48,000. They are saying we will disallow how much your expenditure minus FMV. So whatever is the excess, how much is the excess portion? 8,000. So they say 8,000 will only be disallowed. In other words, expenses up to the fair market value of 40,000 that is allowed. So out of 48, we allow 40, we disallow the excess portion. Correct? So what does 48.2 does? It does disallow only excess portion. Correct? Next, another small disallowance section is, now we all know as employer, you have to deposit in different funds relating to employees, like most common provident fund, ESIC funds, and similar other funds of employees, because this is mandated by laws. Now, within these funds, there are two categories. One is those funds which are recognized by the income tax law and which are unrecognized. Both are legal. Unrecognized is not illegal. It is legal, but income tax conditions relating to the fund are not complied with. So Income Tax Act does not recognize it. So they may be called as recognized, unrecognized, or approved, unapproved funds. Now, income tax law says when you are making payment to these funds as mandated by different laws, and obviously this is for your employee, you are paying in the capacity as employer, it satisfies the above four conditions. It is a business expense, it is revenue, it is not an offense. But since we ourselves have created this category of unrecognized funds, unapproved funds, if you are making payment to them, it will be disallowed. So in other words, restriction is only payment made to approved or recognized funds is allowed. Payment made to unapproved funds, unrecognized funds is disallowed. I hope this restriction is also clear. Yes, students. So I've covered three restrictions today. So we have covered all the golden rules, that is all the conditions for getting deduction between 30 to 37, which I have not taken section wise or expense wise, which I have taken logic wise. Second, we have started discussing what are those certain specific restrictions or disallowances where a particular expense will either not be allowed completely or will be allowed subject to some restriction. Now, when you want to apply PGBP provisions, you have to test every expense from both sides. One, whether conditions are satisfied. Two, whether that expense is having any specific restriction or a disallowance. Only after you satisfy both. So here, as I had written, that for expense or the debit side, you have to apply two things. The golden rules, that is the conditions with exceptions, and check for restrictions. Only when you satisfy both, only when you manage both, you are eligible for the deduction, or else that expense may not be allowed. Correct? Kuldeep is asking, sir, penalty on delayed filing with IT. See, I already mentioned, Kuldeep Beda, where IT, that is income tax itself, is disallowed, any interest penalty on it will be disallowed. But where it concerns with other taxes like GST, customs, or here you have written MCA. So MCA is the Companies Act related portal. So where there is penalty imposed under any other act, there you will check or apply the rule of whether it was for an offense or it was a penalty for some non-compliance. If it is offense, it will still be disallowed. If it is non-compliance, it will be allowed. Divya is asking, sir, how we find out market value, as we have to look after many things. So Divya, if you are asking in the question, don't worry. In the question, it will be given. In real life, see, practically, market value is presumed. How? See, if let us say same example, you are buying from your brother's shop. So that brother is selling the goods to others also. So that is sufficient if he is selling to you at the same price. Correct? The problem is only when he is charging extra. So finding out market value in real life is by taking the same goods or services from a parallel businessman in the market, or where the same businessman who is your relative is charging to other customers. That is how you decide. Harsh Beda, this PDF will be uploaded by BOS. So there is a mechanism by which they will go through the entire PDF and they will upload. So I'll request them to do it today, right? So Anil is saying, sir, we simply have to focus on this. The rest all general points, sir. I did not get this point, Anil. You are saying we simply have to focus on 48,735 AD. Why? All points are important, but you'll have to focus on everything. So, beta, this is according to me. I will not canvas this. So I will say that you cannot generalize. See, I've always objected this when anybody is giving me a generalized logic. So this I will not accept, beta, that only focus on two. As we proceed, when we go to the technical sums, you'll find that you have to focus on all restrictions, not only these two. Yes, Virali, I've purposefully kept this for the next class discussion, that what if you pay less amount than fair market value to your specified person. So I'll keep this open for everyone to think and come back, right? Obviously, Harsh, beta, I know that. See, the problem with the law itself is that the law is very vast and the law is designed in sections. I am designing the same topic in logical format or the format which helps you in handling practical sums. So definitely we will be uploading this. This is designed for you all only, but we have a process in BOS. So I have already sent it. They will be going through the process and it will be uploaded. In fact, I had myself requested them not to upload it before the class. Why, I'll tell you. Because see, had this been uploaded before the class, you all would have read this also like any other theory. And like what you are saying today, that you are finding it helpful or easy, that would not have been helpful or easy. In fact, this also would have been confusing. Why? Because see, until unless I am explaining it to you, the logic or the flow in my method, this PDF is also a theory. This PDF is equally or rather more confusing because it is a shorter version. Fine. So don't worry, it will be uploaded. But I purposely have requested them to upload it later. Reason being, I first want to explain it to you all so that you understand this in my logic, so that using this will be helpful. Yes, Veda, Divya, no problem. You can refer to May 26. Because as far as income tax is concerned, the Finance Act has not done many changes, but yes, there are changes, obviously. So you should generally refer what is relevant to your exams only. Correct? Navneet Beda, so this is the exact question I posted of Virali. So I want answers from you all, but now I'm giving you time to think. So I was going to take up this in the next class. Since Virali posed this question, I've posed to you all, right? Okay, what will happen if you are paying less than the fair market value? Exactly, Kuldeep. So CA is vast, CA may be technical, but that is why you command respect. Because people respect those who are better or who are at an elevated level. So we also respect those who are at elevated level, maybe because of their age, because of their experience, or because of their knowledge. That is where even if you as a youngster, let us say of 20, 22 years, 25 years, is standing in front of a person of 45 years, the 45-year person will still respect you because you are elevated in terms of knowledge and your expertise over the subject. Fine. So thank you all. We conclude our session here. We continue this in the next class. Thank you. Good day. Yes, sir. Thank you.